What insidious forces are draining the lifeblood from Arizona's urban centers? Is it the relentless thirst of a parched desert? The crushing burden of unsellable properties, abandoned by a vanished legion of buyers and panicked investors? Or the fragile foundation of economies built on fleeting booms? Today, Discover the Nation pulls back the curtain on this unsettling reality. We have identified the top 10 Arizona cities that are becoming ghost towns in 2025. These aren't just names on a map. They are places where the promise of a fresh start has withered into an eerie stillness, where for sale signs proliferate like tombstones, and where the echoes of a vibrant past now mock a hollow future. Could the equity in your next investment be crumbling? Or is the street you call home destined for an unnerving quietude? Join us as we expose precisely where Arizona's once bustling dream is dissolving into a ghostly whisper. For more crucial analysis like this, consider hitting that subscribe button.
Number 10. Surprise. Surprise, once a poster child for booming desert development, is now a city caught in the teeth of the housing downturn. This rapidly expanding master-planned community northwest of Phoenix thrived on the promise of affordable homes and a relaxed suburban lifestyle. Retirees flocked here for golf courses and sunshine, while young families were drawn by sprawling new subdivisions. But in 2025, the cracks are impossible to ignore. Zillow data shows the average home value has slipped to $420,000, a 5.3% decline in just 1 year. On paper, that may not sound catastrophic, but when coupled with a 45% surge in active listings, it signals a market oversaturated with supply and short on demand. Builders, once confident, are now desperate. They're offering mortgage rate buydowns, free appliance packages, and price cuts as steep as $50,000 just to keep projects afloat. Many of the homes being delivered today were started during the feverish boom of 2021-2022, and they're flooding into a market with far fewer qualified buyers. Median days on market have ballooned to 55, compared to just 8 days during the frenzy 3 years ago. Families are being priced out not only by inflated home values, but also by mortgage payments that have surged nearly 40% due to 7% rates. With local jobs tied largely to retail and service work, wages simply cannot keep pace. Surprise was built on speed and speculation, and now it's becoming a cautionary tale. If you're finding this breakdown eye-opening, make sure you subscribe to Discover the Nation, where we track America's hidden housing cracks before they become headlines.
Number 9. Mesa. Mesa, Arizona, sprawling across the East Valley, once looked unstoppable during the pandemic housing frenzy. Prices soared more than 50% between 2020 and 2022. Driven by migration, investors, and remote workers pouring in from California. But by 2025, the tide has turned. Zillow reports the average home value in Mesa has fallen to $435,000, down 6.1% in just 12 months. What makes this collapse more painful is the contrast. In 2021, bidding wars pushed homes off the market in under a week. Today, listings linger for 52 days on average, and active inventory has swelled by 40% year over year. Desperation is setting in. According to Redfin, over 40% of homes listed in Mesa this quarter have had at least one price reduction, with many seeing multiple cuts as sellers chase buyers who no longer exist. The affordability crisis is crushing demand. Median household income here is just $65,000, which translates to buying power far below what's needed for $435,000 homes at 7% mortgage rates. That mismatch has created a standoff. Sellers can't afford to go lower, buyers can't afford to step in. Meanwhile, investors who once dominated purchases are now liquidating properties at losses, particularly short-term rental owners who are struggling as Airbnb demand declines. Mesa's fortunes are also tied to Phoenix's broader housing ecosystem. As the central metro falters, so does Mesa, magnifying the downturn. Neighborhoods that once thrived on overflow demand from Phoenix now resemble ghost markets, with streets lined with "for sale" signs. The city's housing boom turned out to be a bubble, and it's deflating fast.
Number 8. Glendale. Glendale, one of Phoenix's key West Valley cities, is facing an equally brutal correction in 2025. Once a hotbed for suburban expansion, it now finds itself trapped between oversupply and affordability collapse. Redfin reports the median sale price in Glendale has dropped to $420,000, a 7.4% decline from last year. Inventory has spiked by 35% year over year, with homes sitting an average of 50 days before receiving serious interest. During the boom of 2021, those same homes would sell in under a week, with multiple offers above asking. That fever has broken, and the hangover is here. The economic foundations of Glendale only make matters worse. The city leans heavily on retail, dining, and service sectors, industries that are now struggling under inflation and declining consumer spending. Buyers who might have stretched for a home in 2021 are now locked out, as higher mortgage rates have raised monthly payments by as much as $900 compared to just 3 years ago. Median incomes haven't risen nearly enough to offset the spike. Sellers are slashing prices, but that only accelerates the spiral. Local foreclosure filings are up 20% in the first half of 2025, an ominous sign that more distressed sales are on the way. Developers who banked on non-stop growth are facing vacant subdivisions and unsold inventory. The once fast-growing community that looked like an unstoppable extension of Phoenix is now cracking under its own weight. Glendale is a clear warning. When speculation outpaces sustainable growth, collapse isn't just possible, it's inevitable. And here on Discover the Nation, we're committed to exposing these fault lines before they sink unsuspecting buyers. Hit that subscribe button to stay ahead of the storm.
Number 7. Marina. Marina, a fast-growing suburb northwest of Tucson, once looked like the blueprint for sustainable desert living. Master-planned communities sprouted across its desert landscape, fueled by retirees seeking tranquility and families chasing affordability. But in 2025, that foundation is crumbling. According to Redfin, the median sale price has slipped to $485,000, down 8.2% year over year, but the real problem is demand. Home sales have collapsed by 25% compared to last year, leaving builders with a backlog of unsold homes. Listings now sit for a median of 55 days compared to just 35 days a year ago, proof that momentum has evaporated. Developers are throwing everything at buyers: mortgage rate buydowns, $20,000 in closing cost credits, even backyard landscaping thrown in for free. Yet the offers aren't working. With rates above 7%, a $485,000 home translates into monthly payments topping $3,500 before taxes and insurance. For a city where the median household income is barely $70,000, the math no longer works. The affordable alternative label that once shielded Marina is gone, and now it mirrors the same cracks seen across Phoenix and Tucson. Even worse, speculative investors who bought at the top are panic listing, slashing prices to unload properties. With oversupply rising and buyers retreating, Marina risks becoming a showcase of empty subdivisions and fading optimism. If you want to stay ahead of America's unraveling housing story, make sure you hit that subscribe button to Discover the Nation. We bring you the markets at risk before they hit the breaking point. Number 6. Peoria. Peoria, a once thriving suburb in Phoenix's West Valley, now stands as a stark warning of overreach. The city's boom years were fueled by massive in-migration, speculative building, and developers convinced that demand would never slow. But 2025 tells a different story. Zillow data shows the average home value has dropped to $470,000, down 5.8% from last year, and sales volume has cratered 20%. Inventory has surged by more than 40%, creating a glut of homes with no buyers in sight. Sellers are slashing prices, with over 35% of active listings seeing cuts this quarter. Some homes have been reduced by $50,000 or more within weeks, chasing buyers who remain hesitant.
Mortgage rates over 7% mean that carrying costs on a $470,000 home now exceed $3,100 a month with taxes and insurance. For local families relying on incomes from Peoria's service and retail-driven economy, that cost is simply unsustainable. Even investors, once a key driver of this market, are walking away. Rental yields can't keep up. Median rents of around $1,800 barely cover half the cost of ownership. That gap is driving a new wave of distressed sales and pre-foreclosures, already up by double digits across Maricopa County. The once prized promise of suburban stability is unraveling, leaving Peoria residents stuck with overpriced mortgages and underwater investments. We're exposing the truth about America's most vulnerable housing markets before the headlines catch up.
Number 5. Flagstaff. Flagstaff has always been different. A high-altitude refuge known for its cooler climate, vibrant tourism, and the presence of Northern Arizona University. But in 2025, even this mountain escape is cracking under housing market pressures. Redfin reports the median sale price has slid to $550,000, down 7.1% in just 1 year. More troubling is the sales collapse. Transactions are down 28%, and active inventory has surged more than 50%. Homes now linger for 60 days or longer, a sharp contrast to the bidding wars of 2021. Affordability is the central issue. With mortgage rates above 7%, a $550,000 home now costs families over $3,700 a month to finance before property taxes or insurance. For a community with a median household income near $65,000, that price tag is crushing. Investors who once banked on strong Airbnb demand are also pulling back as tighter regulations and slowing tourism limit profits. Rents have plateaued around $2,000, far below the costs of ownership, leaving short-term rental operators in the red. Flagstaff's seasonal economy adds another layer of risk. Tourism-driven businesses contract in winter, meaning fewer stable jobs to support inflated housing costs. Combined with the surge in unsold listings, the city is seeing early signs of a housing correction that could deepen rapidly if tourism falters. Once a symbol of mountain town desirability, Flagstaff is now locked in a dangerous cycle of oversupply and unaffordability. And here's the reality. What's happening in Flagstaff today could spread to similar tourist-dependent markets nationwide. For more crucial updates like this, subscribe to Discover the Nation. We're here to make sure you see the warning signs before they become financial disasters.
Number 4. Scottsdale. Scottsdale, long branded as a desert playground of luxury resorts, world-class golf courses, and multi-million-dollar estates, is now staring at one of its harshest housing resets in decades. Zillow reports the average home value has fallen to $850,000, down 8.8% year-over-year, a stunning reversal after prices soared more than 60% during the pandemic frenzy. Inventory has exploded, with listings up 60% compared to last year, and homes now sitting on the market an average of 65 days. This is a far cry from 2021, when luxury homes were snatched up in bidding wars within a week. The luxury segment, once Scottsdale's crown jewel, is now its weakest link. Redfin notes that over 50% of listings in the city have already seen price cuts this quarter, and high-end properties are languishing for months with no offers. Sellers who once demanded all-cash closings above asking are now quietly dropping prices by 6 figures to get attention. Meanwhile, mortgage rates above 7% have shrunk the buyer pool dramatically. Even affluent households are hesitant, with carrying costs on a median-priced Scottsdale home exceeding $5,000 a month once property taxes and insurance are factored in. Developers who rushed to build luxury condos and gated communities during the boom are now sitting on unsold inventory, contributing to a price war that is dragging down the entire city. The reliance on wealthy out-of-state buyers, many of them second home seekers or investors, has become a liability rather than an asset. And as those buyers retreat, Scottsdale's market is freezing in place. This is the reality behind the glossy marketing brochures, a market built on exclusivity that is now drowning in oversupply. Number 3. Tucson.
Tucson, known for its adobe architecture, desert landscapes, and vibrant arts community, is quietly slipping into dangerous housing territory. Redfin reports the median sale price has dropped to $380,000, down 7.4% compared to last year. But the deeper issue is demand. Home sales fell 22% in July 2025, one of the steepest declines in Arizona. Active inventory is up more than 30% year over year, leaving sellers competing in a crowded market where homes linger an average of 55 days before going pending. Nearly 40% of listings in Tucson have seen at least one price cut this quarter, according to Redfin, with some slashed by $25,000 to $50,000 in just weeks. Affordability is at crisis levels. Mortgage rates above 7% mean a typical $380,000 home now costs families over $2,800 a month with taxes and insurance compared to $1,800 only a few years ago. For a city with a median household income of about $58,000, the math simply doesn't work. The local economy compounds the risk. Tucson is heavily reliant on education, healthcare, retail, and service industries. While these sectors provide jobs, they don't generate the wage growth needed to support inflated home prices. Investors, too, are retreating. Rental yields have collapsed as average rents plateau around $1,500, far below the cost of ownership. Short-term rental operators, once confident in Tucson's tourism appeal, are dumping properties amid tighter regulations and weaker demand. What was once a city marketed as an affordable alternative to Phoenix is now becoming a cautionary tale of oversupply and overpricing. If you're finding this analysis vital, hit that subscribe button to discover the nation. Because Tucson isn't just a local story, it's part of a national housing unraveling that every buyer needs to understand.
Number 2. Chandler. Chandler, a major East Valley suburb that prided itself on tech-driven growth and family-friendly neighborhoods, is facing a housing downturn that cuts deep. Zillow places the average home value at $520,000, down 4.8% over the past year. On the surface, that decline may look smaller than other Arizona cities, but the warning signs are flashing. Home sales are down 18% year over year, and active listings have surged by more than 40%. What once was a red-hot seller's market has cooled into a gridlock of overpriced listings and dwindling demand. Redfin data shows that 35% of homes in Chandler have seen at least one price cut this quarter, with many dropping $30,000 to $60,000 in an attempt to lure hesitant buyers. Affordability is a crushing factor. With mortgage rates above 7%, monthly payments on a $520,000 home now stretch beyond $3,400 with taxes and insurance. For families relying on Chandler's median household income of around $82,000, these numbers are dangerously tight. The local economy, while bolstered by tech firms and semiconductor manufacturing, still has vulnerabilities. Not every household works in high-paying tech roles, and service sector workers are being priced out entirely. Investors who rushed into Chandler during the boom are also unwinding positions, as rents averaging $2,000 failed to cover ballooning ownership costs. Even corporate relocations, once a steady driver of demand, have slowed in the face of high interest rates and economic uncertainty. Chandler's fall illustrates the broader pattern across Arizona. Cities that soared on speculative construction and pandemic migration are now correcting hard.
Number 1. Phoenix. Topping our list as the single most at-risk market in Arizona is Phoenix, the very heart of the desert boom and now the epicenter of its unraveling. For years, Phoenix was America's fastest-growing metro, a magnet for out-of-state buyers, investors, and developers who believed the desert would never stop producing profits. But in 2025, that story has collapsed. Zillow places the average home value at just $411,916, down 4.4% year over year. That may look modest on paper, but when paired with inventory up 54.3% and demand evaporating, it signals something deeper, a structural correction with statewide consequences. Homes are taking 33 days on average to sell, but that number hides the truth. Many linger for months with repeated cuts. Nearly one-third of active listings have already slashed their asking prices, some by $50,000 or more, and yet buyers aren't stepping in. With mortgage rates above 7%, monthly payments on even a modestly priced Phoenix home now exceed $2,900, including taxes and insurance. For households earning the city's median income of around $72,000, those payments swallow nearly 50% of take-home pay. Affordability has collapsed, leaving locals locked out of the market they once drove. Even more alarming is migration. Phoenix, once synonymous with population growth, actually lost 1,800 residents last year, the first net decline since the Great Recession. High living costs, skyrocketing insurance premiums due to wildfire and extreme heat risks, and declining affordability are pushing people elsewhere. Investors who once made up nearly 25% of Phoenix buyers are bailing, dumping rentals as yields vanish. With median rents hovering around $1,800, they can't cover ownership costs that have surged far beyond reach. Developers, too, are caught in the trap. Thousands of units approved during the pandemic are still hitting the market, creating a glut of new construction nobody can afford. That oversupply is colliding with shrinking demand, forcing builders into a price war that is dragging the entire metro down. Phoenix isn't just slowing, it's stumbling badly. And if this correction deepens, the fallout could spread across Arizona and the broader Sun Belt. Because Phoenix's unraveling isn't just a local story, it's the clearest warning yet of what could hit your city next.
This has been a comprehensive look into the modern ghost towns of Arizona. From the serene suburbs of Surprise to the bustling heart of Phoenix, the message is clear. What was built on an illusion of endless growth is now crumbling under the weight of reality. The lessons from these cities are a painful warning for us all. A healthy housing market isn't defined by explosive price growth, but by a stable, affordable, and diverse economic foundation. The dream of a quick fortune in real estate has shattered, and what's left is a powerful reminder that overconfidence and speculation can turn any market into a high-stakes gamble. If you want to stay ahead of the curve and protect your financial future, subscribe to Discover the Nation. We'll see you in the next video. Because sometimes the most valuable knowledge of all is knowing where the house of cards is about to fall.